No, I always love when I have this guy on with me because, again, I know you guys are sick of hearing it to a degree, but if you're new to the show, he speaks, finances in a way that we can all understand it, easily understood, at least for me. And that's all I really care about right now is me. David Fischer, CEO of Landmark Capital, joins me as he does every week to kind of give us what's going on in the economy, what's going on with your money, how to protect your money, and what those fools in D.C. What the legislators are doing in D.C. David, thanks for being with me today.
You're very welcome, Joe. It should be all about you when you're looking at your finances, just like it's all about everyone else when they're looking at their finances.
Yep. Hey, the Fed came out with a big announcement today. They raised their rate by a quarter point, or 0.25%. I mean, that doesn't sound like a whole bunch, but it does have an effect on the market, doesn't it?
Well, we saw a whole lot of volatility in the first 3 minutes, and it continued on, not as aggressive in the first 3 minutes. Stocks were up. The Dow was up a couple hundred points. Within a minute and a half, it was down about 95 points, so it dropped half of its gain. And then, a minute and a half later, it's back up at 200 points. The Treasury yields spiked up, came back down a little bit, not much as it went up. Like the Dow went up as much as it came down and went back up. So there's this yo-yo effect. It's, you and I, the average investor, we ignore all that. This is trader-induced, literally right before, and I have CNBC in my office on the televisions, the Wall Street on the floor of the New York Stock Exchange, they were applauding loudly with the prediction of what's getting ready to happen here. So, it's euphoria. But we ignore that. The bigger thing to look at is the trends that not are a minute or a day or a week, but a month, a quarter, a year.
Right. Hey, but wait a minute. Come back to something. When you say trader induced, that's the guy that's having a cup of coffee at 6 o'clock in the morning, and he's bought a program that helps him buy and sell in minutes and seconds. Correct? That's what you mean. It's
that guy, and it's also the guy that he's placing the trade through on Wall Street, who is actually placing the trade, or what you call closing out the trade between, you're seeing the movie Trading Places. It's those guys that are yelling at each other with tickets. That's the Chicago Board of Exchange. They do it electronically on Wall Street, on the stock floor in New York. So, but that's that guy that's, placing the trades that the trader in his home put through on a short period of time. They call it day trading, swing trading.
There you go.
It's a short period of time. It's not a buy and hold philosophy.
No, and the more seasoned guys, the more seasoned professional traders, if you would, are they easily swayed by these kind of things, or are they usually able to hold ground?
No, it's not that they're not making. Most seasoned investors are not doing what I do, watch what the Fed is doing, and making a trade in reference right after the Fed announcement or right before the Fed announcement. The seasoned investors, depending on what you classify as seasoned investors, if he's trading options or he's doing a swing trade, that is a very seasoned investor, and he's going to react every minute, every 10 minutes, every 15 minutes, and he's moving his money in and out. That's a certain type of a seasoned investor. Most people are not that type of a seasoned investor, but they might be investing in stocks for 10 years, 15, 20, 30, or 40 years, but they're not making short-term calls or short-term trades. They make a week or a month. They're called a trending trade, or a 6-week period of time typically is what those types of traders are going to do.
Right. So then this long term, the quarter point, this is not going to affect long term how the stock, how the market moves, right? I mean, because it's not a day by day. I mean, long term investors are going to look at this and they see that the market's kind of settling in, or I don't know what the word I'm looking for here. What did you call it? It's going to balance itself out.
They adjust to the Fed's rate hikes is what's happening. The Fed's been raising rates here now for a little over a year, and the Fed came out and said they expect more growth in the economy, lower unemployment. but they still want to hold the inflation rate at the same, which is the core inflation rate for the Fed target is 2%, and it's at 1.9%. So this means they're under target of where they see inflation. Therefore, the higher that rate goes above 2%, the more they have to react in raising rates. They did, though, say for 2019 and 2020, the Fed raised the outlook of more rate hikes to come, more than what they expected and said before. So we're going to have higher rates quicker than what the Fed anticipated a year ago for 2019 and 2020, which means we're going to have higher inflation indirectly by the Federal Reserve's outlook looking forward. What does this do to the market? Well, the market doesn't like inflation. The market doesn't like higher rates. The market doesn't like uncertainty. This bred certainty today because the Fed actually gave us a map, what they're doing here in the short term and what they're going to do the next 3 years. What it does, though, is it typically higher rates, the market does not like that. We're not in the higher rate environment yet. And getting to where the Fed target rate is 3.5%, 3 years from now, or 2.5 to 3 years from now, in perspective, 3.5% of Fed lending rate is not a high rate. 5.33% is the average over 50 years. So we're still under the normal of a 50-year rate, Fed lending rate. But everybody loves this cheap money. Now the market's trying to react to what it's going to be like not having cheap money, and that's going to still yet to be tell. Most people are saying it's not going to react in a positive way. Eventually, we're going to have a change in 2019 or 20, and there's a lot of people coming out now saying that again.
Yeah, when we come back from the break, a couple of things I want to talk about. Some people don't quite understand an inflation rate and what it does. I always like to bring it down to the 9 to 5, or the guy that's busting hump for his family. He's working 9 to 5 every day, or 8 to 4, whatever it is. And how does this whole thing affect him? Anyway, I'm Joe Messina, your host. This is The Real Side on GCN Live. Don't go far. A lot more with David Fischer. After the break, what to do with your mega bucks, or little bucks, or whatever. We'll be right back. Back with David Fischer, CEO of Landmark Capital. I always have a good time with him because he can explain things that I turn on these financial channels. It's like I have no clue as to what they're talking about. They lose me pretty quick, but David never loses me. And David, thanks for being with me and helping us understand what to do with our finances. It's a good thing to know.
Joe, once you were lost, now you've been found, but I'm not your savior.
No, you can be my gold savior. How's that? Hey, so, one of the things that we talk about, and people send me emails and they ask me, and kind of go Google it, but let's hear it from you. I said it on the way out on the last segment. If, you talk about an inflation rate, come on, what does that mean to me? I'm coming home, I'm going to grab my 6-pack of beer, I'm going to grab a loaf of bread for the family, I'm going to sit at my table. What does an inflation rate actually mean to the average Joe, if you would?
Well, unfortunately, grabbing the 6-pack of beer and a loaf of bread, the Fed doesn't factor in food, housing, or energy in what you call the core inflation rate. Yet the last time I checked, we need to have food, we need a place to live, and it costs energy, electricity, and oil to put gas in our tank, in our car. Those all things cost money, but the Fed a long time ago took away those 3 components that are really probably the most important 3 that everybody goes by. So they use a different yardstick. Unfortunately, this is what why many people have accused the Fed as manipulation. They're not being transparent, they're not being real, and what real inflation is, because the average Joe sees that. I don't know how much beer has gone up, but bread has gone up over the years.
Right.
Because grains have gone up over the years. And oil has gone up recently. And so the manufacturing cost to produce a loaf of bread has gone up. So where does that happen? It all gets passed off to the consumer in higher food cost. We've had probably higher energy costs. Gasoline is not going down. It's going up. So the cost of living is different than inflation. Unfortunately, the Fed does not use the cost of living, what we're talking about, as the metrics when they talk about inflation. They use other things. So just kind of take it with a grain of salt when the Fed says there's not much inflation. They are right when they said, we've had lower unemployment. Unemployment's been going down, but also wages. We've had wages not responding in the last 9 years. So we're still in a predicament as a country. Wages are not going up, keeping up with the cost of living, because in the last 9 years, cost of living has gone up, but wages have not. So there's the parameter there that the Fed still doesn't factor in to, raising rates. It's a little bit ambiguous. I think what will happen, though, is when we get to higher rates next year or the year after, that's when things are going to take a big change. That's what we're watching. But right now, I think it's just kind of a little bit of volatility happening in the markets this year. Well, some of it's a lot, depending on what day. The 15th and the 30th, the Fed sells treasuries, and you can see a direct result of volatility in the markets 1 to 3 days after that. And that's what's been happening. That's what happened on Monday, and that's what happened on Friday. The Dow was down several hundreds of points. That's the Fed selling the balance sheet.
Well, you know what? You've been talking about this for a long time. You've been talking about how the market's going to be affected by certain things, and I never get nervous. I love these people send me emails like, "Oh my God, it's over." No, it's not over. Just relax. And I've been listening to you, and I got to tell you, 98.9% of the time you've been right on. And if you hit 100%, then there's something wrong with you. You got an inside track somewhere. But, one of the things you talk about on a regular basis, and I really appreciate it, and a lot of guys will go a third, but you actually go a little further with it. You say, when it comes to investments, when it comes to your money, you should have 25, 25, 25, 25. And you go to, real estate, stocks, cash, and precious metals. But the question I get on a regular basis, because people really don't understand the difference, is when it comes to gold, we'll just talk about that for a second, what do you do with the gold? I mean, so I buy a coin from you. I buy some kind of coin that's worth a heck of a lot more than the face value. If the crap hits the fan, I go down and buy bread with it. What do I do with it?
Well, you're not going to go to the grocery store or the bank with your gold. Neither are you going to go to the grocery store or the bank with your stocks. So you got to look at it as just another tool in the portfolio that does something different in economic uncertainty that stocks can't do and cash can't do. So typically let's go back in time, 2007. That affected just about everybody in the United States, if not a lot of people in the world. I mean, hardly anybody. In fact, I have not come across one person that said they were immune and they were not affected financially in any way, shape, or form from 2007. I've also found out that most people believe they didn't fix 2007. They just put a Band-Aid on it, which means we're going to have a repeat of it, which, we talked about this last week on your show about this bill that the Senate passed, and if we have time, we'll talk more about that. That's just giving the green light for 2007 to happen all over again on the banking industry. And there's some good things to that bill. But back to gold and back to your question. In 2007, if you followed the plan that I've said for decades and decades, because I've been doing this for 25 years, August of this year will be my anniversary of 25 years.
Wow.
And you followed the plan that I've said for close to 20 years is when I said this, putting 25% in stocks, 25% in cash, 25% in real estate, and 25% in gold. In 2007 happened. Here's what happened. Stocks came down 40%, and it took almost 7-8 years for people to fully recover that. And some people I've found out recently, one person we're talking to out of California, they lost 70% of their money in the stock market downturn in 2007, and they still haven't recovered from it. So, but I'm taking the conservative number, 35 to 40%. That went down. Most people's real estate went down. So what was the purpose of cash? And what was the purpose of gold to have that? Well, cash subsidized the wages was the cushion for when you had to retool yourself, find a new job if you were in that situation, or loss of income as a result of a massive downfall or recession that we went into. Cash on hand was the subsidizing factor. Gold, so use it as that, as in a financial insurance policy. Gold was also a financial insurance policy, because cash didn't go up, 25, 35, 40% to offset the downside of real estate going down 35, 40%, in some cases even more, or stocks going down. Cash was just a revenue source to subsidize your income or wage losses. Gold, though, was on the other side of the two scales of investments. Gold went up 51% the first year in 2008 and went on a multi-year run and went up 2.5 times within 3 years. So gold was the financial stability insurance policy that offset the losses in stocks and offset the losses in real estate. So that's did you go down to the grocery store to use it? No, they don't accept gold. They don't, neither do banks. But it's just like a stock, but it's something that goes up and it's tangible when other assets are in volatile markets and go down when there's uncertainty. So that's why it's very important, because we're going to face another 2007 again. In fact, this time it's going to be triggered, in my opinion, by something I've been saying, the bubble that the Fed's created. Anytime there's a bubble and it bursts, that's where we're going to have a huge problem. Well, this bubble is the biggest bubble in the history of my life and probably maybe the history of our country. When the Fed unravels the treasuries, and there's the problem that's now starting to come into effect. Look at what it's been doing to the volatility of the market. When they completely, fully start to unravel this, because they're still in the early stages of this. They won't get to the latter stage really till the end of the fourth quarter this year and the beginning of next year. And that's where we're going to have some problems. Mark my words, this is my prediction. Next year we're going to have some financial problems. And it'll be because of who's going to hold the dollar. Well, when that happens, you want to make darn sure you want to own some gold before then. And so I'd say I'd rather be 2 years too early than 2 years too late. My prediction, I said on your program in January, that we're going to have volatile markets and we're not going to have the same increases in the Dow that we saw last year, not even close, single digits, and look at where we're at. The Dow is flat, and we're almost getting ready to go in the second quarter.
He's always right on, and he's got to wait. If you want to know what this all means to you, the quote-unquote 9-to-5er, stay with us. A lot more with David Fischer after the break. I'm Joe Messina, your host. Well, we're back with one of the buddies of the show. I always enjoy when David's on with me because I really do get a lot out of it, and many of you have been letting the emails kind of pile up. Some of the questions you ask, go Google them. They're so easy. Oh, they're easy for me anyway. Anyway, David Fischer joins me, CEO of Landmark Capital. I always have a good time when he's on the show with me because he's not one-sided. He doesn't have that mono kind of look at everything. Stocks and precious metals, bank, that's it. He doesn't look at things like that. I always appreciate the way he comes at things. David, always a pleasure to have you on with me, seriously.
You call me your buddy, and always a pleasure. I'm getting ready to say a 4-letter word on your program.
Oh,
here,
no.
So I'm warning the listeners here. I'm going to give out the dirtiest 4-letter word in the history of our government in a second. You ready?
Okay.
Don't bleep me.
Go ahead.
Math.
Well,
the math. The government doesn't understand it. They can't balance it. They don't want to do anything about their spending. There's nearly ever enough for them in money, and they're clearly driving our country into bankruptcy. I mean, they do not understand a simple word called math. You cannot spend more than you take in. I mean, it's insane. I've said this before. I'm the voice in the wilderness of John the Baptist, so to speak. But I'm telling you, this is going to come to fruition in the next year or two because this time it's different. We have an economic powerhouse economy, and during this time we should be paying our debt down, not going fastest in the debt in the history of our Treasury ever, issuing Treasury bills to suffice the massive overspending that our country is doing. It's insane, and while that's happening, the Fed is unwinding the balance sheet. China just actually confirmed here recently, the Treasury just confirmed that China, what I said on your program in January, that they might be selling U.S. dollars. The Treasury just came out last week, confirmed there was a massive sell-off by the Chinese central bank selling treasuries in the month of January. So, I mean, we're having these factors happening this time that we've never had before. At the end of the day, it comes down to math. Who's going to hold the debt of our country, because that's all the Treasury is. It's just a debt instrument to allow us to continue to spend. And the national debt has grown the largest 36% recently, jumped 36% recently in a single day span of $73 billion from what it was supposed to be, the jump. And it's crazy what we're doing as a country. But, we think it's all fine. We're not talking about it because it's not a popular subject. But it is the undergirding system,
Yep.
what you call sovereign debt, is the largest asset in the world, and we represent $40 trillion of a $86 or $96 trillion sovereign debt.
What's a few $trillion among friends? You know what I'm saying? Hey, but I want to come back to this. Look at I just before we went to the break, I said consumer confidence is up. It's been up for quite some time now. Consumer debt is up though. People are at way up there on the credit card debt and other places, and you're looking at a housing bubble. It used to be that people could depend on the equity in their homes to live off of, but all of that is being consumed. But you've talked about it. Other economic experts have talked about it. There's still a bubble bust to come on stocks and bonds and in the housing world. Does this scare you at all? Your little crystal ball working at all in this area, or what?
Well, come on, this is not an old news thing. This is a new news thing. This is an old news. Scripture even talks about in 7 years of feast, put away grain for the 7 years of famine coming. Yep. What happens in human nature, though, it's the way man has been as created, the fall of man still, we don't get it. We think in good times that bad times will never come, and when bad times hit, we can't imagine when good times will ever come again. But this thing runs in a cycle, and this is why during good times you pay down your debt. You don't go further in the debt because the good times will not last forever. It will change, and we will have another recession. Listen, it's simple as this. Out of 9 out of 13 times that we've gone into recession, when what you call the rates become inverted. In other words, long-term rates, a 30-year Treasury bill becomes less of a rate, cheaper than a 10-year note. Typically, the longer you hold out a Treasury bill, the more rate you should be paid. What's happening here is short-term rates have escalated and long-term rates are coming down. We're getting ready to have an inversion. 2.9% is the 10-year, and the 30-year is 3.1%. There's not much of a difference between those two notes. If we see this inversion, the likelihood of a recession coming is pretty probable, and that's going to happen sometime. They're predicting around next year where you're going to see this rate inversion. I'm talking technical, but this is just another huge and a very reliable barometer that says bad times are going to come, and when they come, you can't have this huge debt structure because that's when it becomes tougher to manage a high debt level. This is when you'll be paying down your debt. So, but in good times we forget about that. I love when people, talk about that they're comfortable, they can just pay their bills, but it's not always about just paying your bills. You and I were talking during the break that in Australia, they use their house, the equity in their home is kind of like the retirement plan, if you would. We can't do that here anymore, can we? Well, prior to 10 years ago, for greater than 50 years, prior to 10 years ago, that was the case. The number one assets that Americans always, and it was the American dream to own your own home. Have a home, have a mortgage, pay that mortgage. And historically, for the most part, decade after decade, Joe, those homes escalated in value much faster than the liability of the mortgage that was on it. And it was a great asset to hold, and usually the number one asset. That's not true anymore, and it hasn't been true for 10 years. And I'm going to make a prediction. It probably won't be true for the next 10, 20, 30, 40, 50 years until they get the debt structure of our country back in order. That's what's driving this thing. We made a shift as a country in 2001. The Fed made a shift. The government made a shift. And they've been propaganding this 4 or 5 years prior to that, to saying how debt is a good thing to have. And now we're paying for the ramifications of having a high debt structure. and mortgages are a debt instrument. And when you have this environment where it doesn't work, now imagine how bad it's going to get as rates go up, because that environment was created when we were at artificially 45-year low rates. Now we're going to get to normal rates. It becomes even more exasperated. So until the country gets its debt in order, you're going to see, in my opinion, real estate not keeping up with wages, because that's the problem. There was not enough wages rising to suffice to support real estate prices going higher, because that's why you're not seeing real estate prices move aggressively, 4 or 5%. That's an aggressive move in a real estate. 1% is not a normal to 2% a normal move in real estate. We had 40-50% moves in real estate in 2006. That was unheard of. We're not going to see those types of years again. And I think that until they get wages stimulated, real estate's not going to be the number one holding asset. Since then, it's been 401ks, but unfortunately not everybody contributes to their 401k. This is why, we talk a lot more than about other assets than just about gold. I encourage people, if you have a 401k plan with your company, contribute to it. It's tax-free. You're getting, if they give you matching funds, they're giving you free money.
Wow.
So do all those things.
I'm good
Set
with free
aside
money.
some money. Yeah, it's always good to get free money.
All right, you got about 2 minutes, my friend. So let's talk about the white paper that you've got. Time is up. Which bubble will burst first? Oh, boy, we went through all of that. Yeah. Where do they get the paper?
They can call our company, or they can go to our website, landmarkgold.com. They can call our company, 844-715-7311. By the way, on a side note, I was able to save somebody that wanted to buy gold. They called our company. They've been hearing my voice on national radio. They called. They had a 401k. They liquidated. They went, got their money. I said, let's undo that. Let's put it back in retirement. And they were able to do other things. They wanted to tie. They wanted to buy a burial plot. They were able to get all their goals and still buy gold, and they saved almost close to $10,000 in taxes. I was able to save them. Not a CPA, not a tax planner, but I know how the structure works. So, we call this the financial blueprint. I can help a lot of people adjust the way they think and look at this and still get their goals, and safety net there for them. So when this event does come that we're talking about, and it will come, they're properly protected.
And again, it is really, people read, I used to joke around and say people are a victim in the last conversation. In some cases when it comes to your money, you're a victim of the last crisis you heard about. And you watch these commercials and they're trying to get you, yank you in all different directions. And the thing about you that I love, David, is it's, even though you're a precious metals guy, it's not all about precious metals. It's about a very, an equal and constant plan. And that's what I like about you. So, people can get your white paper. They can head over to landmarkgold.com, landmarkgold.com. Sign up for that white paper. You got to get information, right? You have to have information, or else you do everything out of stupidity. I'm Joe Messina, your host. You'll see the real side. Got a lot coming up in the third hour. You don't want to miss it. I'm not teasing you. Just wait till you get there. We'll be back in a few.